Hello, everyone, and welcome to this interesting episode on passive investing. Today, we have with us Arun Sundaresan, co fund manager and head product management at Nippon India Mutual Fund. Arun has been with the fund house for the last 16 years. He has expertise in quant fund. Today, he will speak about Nippon India Flexicap FOF. Welcome, Arun.
Thank you, Nishant. Thanks for having us on the show. Looking forward to this interaction.
So Arun, so first of all, we would like to understand that why do you think it is important to remain invested in the flexi cap segment across all market capitalization?
Quite simple, Nishant. So most of the category of funds, they're fairly well defined. Like, for example, large cap can operate largely in the top 100 stocks, mid cap in the next 150. Value fund has to follow a value theme. All these are, properly defined. That in a way uh, defines the universe for those categories of funds as well. But practically, what happens is that different parts of the market may perform at different points in time. So, if you had to talk about market cap, for example, this year, the calendar year that we're talking about, the last calendar year, the mid caps and small caps have done very well when compared to large caps, which may not have been so intuitive around the time of Corona. But today, as we speak, large cap is up about 32%, whereas mid cap is up by about 45% and small cap by 55%. Whereas if you look at 2018 and 19, it was different. Let me quickly share some data points here. I hope the slide is clear. So as you can see, different times, various parts of the markets have performed. 2018 and 2019, small caps and mid caps gave negative return, whereas large caps outperformed significantly when compared to these two parts of the market. 2017 again, mid caps and small caps did very well, large caps relatively underperformed, and this keeps on happening, right? With hindsight, we can give a lot of reason as to why something performed, why it did not. It's very difficult to preempt as to what is going to perform at any point in time. Therefore, while there is merit in investing into large cap, there is merit in investing into mid cap, in a value fund or any thematic fund. The case for a flexi cap or multi cap fund is to invest across market cap. You don't know really which part is going to fire at what point in time. Just be present across the market cap. Let it work at various points in time. Overall, you are bound to make returns. So that's the concept that we are talking about.
Okay, so Arun, why should investors invest in passive structure for flexi cap exposure?
See, what we've also noticed is that while right now I mentioned about the benefit of investing across market cap, what we also notice is that, and it's quite intuitive, right? The scope of these funds is very, very large, right? So large cap operates in the top 100 stocks, mid cap in the next 150. Whereas a flexi cap or a multi cap, the entire market is a playground. So you can operate between large cap, mid cap, small cap. So you can go anywhere. The percentage of large cap can be anything, mid cap can be anything. So basically, the landscape, the framework for that is very, very wide, which is both good as well as bad in the sense that you can argue that there is a lot of flexibility, but it may be the flexibility may also be a double-edged sword. And if you don't get that right, for example, if you're too much into large cap when actually mid caps and small caps are performing, then you will underperform and vice versa. And this is not a theoretical argument. If you really notice what has happened in various funds, for example, this we took for the last 10 years without naming the funds. We call it Fund One, Fund Two, Fund Three, Fund Four. You look at the performance of each of the fund. There's four funds, right? In the year 2011, for example, the fund called Fund Four was the best performing fund. Fund Two was a worst performing fund. The difference between two was 7.7%. What is more important is that the same fund, the Fund 4, which was in quartile 1, the very next year, it became quartile 3, which means out of 4 funds, it was third, right? And the Fund 2 improved on the performance, and the same pattern keeps on repeating. And the difference between one fund to another fund especially in this category, can also be very large, like 10%, 15%, 20%. This is just, by taking four funds. This is true even if you take the entire universe. So the simple point that I'm driving home here is that the fund performance in this category can be very divergent, and this is very much in line with the mandate of the fund to invest across the market cap. That is why this particular category becomes very, very interesting. At the same time, it has that complication that one needs to be very careful about going about investing. Therefore comes this question, do you really need to pick up, preempt an individual fund? Which of these funds is going to be the best performing fund? How am I going to pick up? Is it going to be based on the last 1 year performance now? Is it going to be based on 3 year performance now? What happens if this fund, which has performed now, the next year does not perform? So rather, instead of trying and picking up an individual fund, is there a case for you to pick the universe itself, pick the average, the sum total of all these funds, get the benefit of flexicap investing, at the same time not be caught into individual funds, right? That's the whole concept of what we are trying to explain here. That number will be the exposure that this fund will have towards large cap, mid cap, and small cap, right? So basically, rather than an individual fund, it could be 80% into large cap, some other fund could be 70% into mid cap. What we do is we look at the average of the category. And let me clarify here, this category used to be multi cap now, earlier, and the flexicap category is just evolving. So therefore, while the fund is called as passive flexicap, the basis will be as per the multi-cap category right now. And as and how this flexicap category evolves, we will go with the flexicap category. So that's the clarification. But again, coming back to this point, so basically the average large cap, mid cap, and small cap exposure of all the funds in the category, which is now multi-cap category, that is what we will go and invest as the underlying in this particular fund. The underlying again will be ETF stroke index funds of Nippon India Mutual Fund. So let me again show you this. So basically what it does is, suppose the large cap exposure, the category average exposure comes to 40%. The fund will invest 40% in Nifty 100 ETF. That becomes a large cap exposure. Suppose 30% is the mid cap exposure. That 30% will be made into Nifty Mid Cap 150 ETF, and the remaining 30% will be invested into Nippon Small Cap Index Fund, which is 250. So essentially 100 large cap, 150 mid cap, and 250 small cap. So essentially you're investing into 500 stocks. But the allocation between large cap, mid cap, and small cap will be basis the average allocation of all the funds. And this will keep on varying as per the industry changes on a month-on-month basis. So this month it could be 40. Next month, depending on how the data comes out, that could be 43, 44. Whatever that number is, that number will be given to us by CRISIL. This is an objective number. By looking at the actual exposures, we will simply go and replicate as per that proportion, and the underlying will be the ETF stroke index funds, like I just mentioned. So the concept is very simple. What you're getting is the benefit of both. So one, you get the industry wisdom. You're not going by the individual fund. You're going by the collective wisdom of all the funds together. Rather than 80% into large cap, the average is 40. You won't invest 40% into large cap. So that is one part, the mutual fund industry wisdom. The second part is the other complication that any active fund has is that you need to be very active on sector calls and stock calls, which again can lead to a lot of outperformance or underperformance. So that part kind of gets averaged out, negated. You get the market wisdom, which is what your ETFs and index funds provide.
Okay. So, Arun, we haven't seen any passive fund outperforming benchmark so far. But ever since this fund was launched in December 2020, it has consistently outperformed its benchmark. So, what are the three things that has contributed to this?
Okay, first of all, this is a recent launch, so December, so it doesn't have much of a track record. Now, having mentioned that, passive funds, when you mean passive funds, typically index funds or ETF, they will never beat benchmark because by design you have an index and then on top of it expense, it tries to replicate and there are tracking error and stuff like that. Whereas this fund is not purely a passive fund, right? So while the underlying is a combination of large cap, mid cap, and small cap ETF stroke index, the exposure to that 40%, 30-30, that can become 50, 25-25, some combination, that number kind of keeps on changing. So in a way, this is a combination of passive and there is a little bit of value addition which comes on. Therefore, it is not entirely a passive fund in the context that generally ETFs and index funds get referred to. Therefore, it may be appropriate to compare this with a smart beta product, which tries to generate some value addition while the underlying is largely passive. So it's in a way the best of both worlds, passive plus active.
Okay. So, Arun, the fund house could have simply launched a passive fund tracking multi-cap index like Nifty 500 TR index. So, why do you think FOF structure makes more sense?
That's a interesting question, Nishant. You're right. We could have done that, but the problem there was Nifty 500 index. While it gives an impression that you're playing the market 500 stocks, technically speaking, because it's a market cap index, right now the last number I saw, it's almost 82% large cap, right? So you think you are investing into a multi-cap strategy across the market cap, and I told you the benefits of that investing not only in large cap, large, mid, and small cap. Technically, by investing into Nifty 500, you are actually investing like large cap. Today, many large cap funds have 80-82% large cap, rest in mid cap and small caps. Not typically, a little less, little more, but that's what Nifty 500 gives you. Whereas our objective here is to give you first and foremost investing across market cap, which is what multi-cap investing does, and a little bit of variation, the flexibility in terms of how much goes towards large cap, mid cap, and small cap. That's another added dimension to this product, which adds a little bit of value, which is what you get the industry wisdom, so to say. To that extent, this product design is very different. It is not trying to replicate an index and try to generate. The idea here is to actively gain from both the market system, which is anyway the ETF index, and top of it there's a layer where you vary this large cap, mid cap, small cap allocation, and hopefully that generates alpha. I'll just show you one a good example. Uh, this is the allocation of the erstwhile multi-cap category, right? Uh, Historically, this is the average exposure, right, over a period of time. Now, what can be noticed here is that, take for example, 2014. 2014, the mid cap and small cap exposure of the category was as high as 40%. Large cap was 60%. And with hindsight, we know that that was a time when mid caps and small caps actually outperformed, right? Now, come to 2018-19, the same mid cap and small cap exposure from 40% came down to 25%. The large cap was 75%. And again, with hindsight, we know that that was a time when large caps did well. Therefore, what can one infer from this? At least at an industry level, at an average level, the mutual fund industry had been able to capture this reasonably well, be more into mid caps and small caps during times when there is broad basing and that part of the market likely to do well, and vice versa. So this fund, in a way, tries to capture that and hopefully will benefit from it.
Okay. So, Arun, but what are the key risks associated with this fund?
That's a good question again. All said and done, while it's called as a passive flexicap fund, right? Uh, Investors need to understand two things. One, this is an equity fund. So any equity fund comes with its associated risk. That's number one. Second, as I started, The Flexicap category or multi-cap investing style invest across market cap, large cap, mid cap, and small cap. A good amount. In fact, the latest SEBI regulation is at least 50% will have to be in mid and small cap, right? So that makes it by design a relatively aggressive product, right? In terms of the potential risk return, I would rate it higher than a pure large cap fund or even a pure mid cap fund. So therefore, to that extent, while some elements of the product might give an impression that it's passive, the only passive element comes from the underlying being ETFs or index. But given that substantial portion is mid cap and small cap, and it's a 100% equity fund, it will be subject to typical risk that any equity fund will have. And within that, relatively more aggressive because it's got a higher component of mid cap and small cap. So that risk, investors need to keep in mind.
So one last question, Arun. Why should distributors recommend Nippon India Flexicap FOF to their clients?
For the simple reason I just explained, that the performance of funds can be significantly different over a period of time. This is what we have noticed as I again showed you in this particular slide. For example, you chose, let's say, the fund one in 2012. This fund was the best performing fund, right? The very next year, the fund's performance slipped. It was in the third quartile. And the difference between the best performing fund, the other performing fund, in this case, was not much, but there can be times it could be 14, 15, 20%, right? Even today, intuitively, you know that with hindsight, mid caps and small caps have done very well. Those funds which were heavily tilted towards large cap could have underperformed, and that underperformance could be 10, 15% when compared to another fund. So a individual fund, especially in this particular category, can have this higher volatility. One year it performs well, the very next year it does not perform well, etc. In which case the advisor will find it very difficult to explain. Market could be at one level, fund's performance could be at a completely different level, so on and so forth. What we are trying to do in this particular fund is that you are taking away that element of risk of an individual fund performing and not performing. You're going by the collective wisdom. So hopefully, when compared to an individual fund, the performance of this fund could, kind of average out in the sense that it could be somewhere in the median most of the time, and that investment experience could be relatively more palatable to investors. And if investors are happy, so can the advisors be. So that's the whole concept about this particular fund.
So with that, we have come to an end to this interesting session. Thank you so much, Arun, for your valuable time and insights.
Thank you, Nishant. A pleasure talking to you. I hope our users find this session useful. Thank you very much.
Thank you.